Good morning, everyone. Welcome back to another episode of Policy and Profits. I'm Anthony Esposito from Island Capital. I have EJ Antoni with me once again, economist from the Heritage Foundation. EJ, how are you today?
Anthony, I'm hanging in, my man. Yet another crazy week in the books. How are you doing?
I'm doing all right. I am winning at life once again. um, so definitely a lot going on still. We had the FOMC meeting last week, the 50 bip cut. Markets are still reeling from that and kind of trying to find their way, which I'd love to discuss later in the podcast. Something came up that you had posted earlier this week on X. It's been out there. You definitely were ahead of the curve in pointing it out, and I really want to talk about it because it's something we're not talking about across the board. I've heard no one out on the street talking about it, but it is. I hit a few traders with it, and a few friends at both buy side and sell side shops, so both brokers and hedge funds and long onlys. And it's something that's shocking them when they see it, and they're interested in seeing more about it. So I think it's a really great topic. You posted something about underperforming assets on the bank's balance sheets currently in the U.S. and kind of related it back to the Fed funds aggressive 50 basis point cut this past week. I think we can throw that graphic up and take a look at it. Would you like to please explain what's going on here? Because it's scaring the hell out of me.
Sure, and rightly so. I mean, this is not a small problem. We're talking about $500 billion in assets here. These are unrealized losses at banks. In other words, if these assets had to actually be sold today, the banks would just take an absolute bath on them. And one of the really troubling things is that it looks like most of these losses are going to be concentrated at relatively few banks. So, there's really only one large bank that I think this problem has become, more or less systemic. But outside of that, it's all the regional banks. In other words, all the banks that were on the wrong side of the interest rate trade back in the spring of 2023 when SVB blew up and a couple other banks as well. So, all right, how on earth did we even get here? Basically, banks in 2020 and 2021 were loading up their balance sheets with tons of assets that were at very, very low interest rates. So they were selling mortgages, for example, at 2 or 3%. They were making different kinds of other loans like auto loans, whatever the case may be, again, at very, very low interest rates. Now, that in and of itself is not a problem, provided you think rates are going to stay very low for a very long time, which coincidentally is exactly what Powell and company was promising the market was going to happen. And the problem is that you fast forward, Anthony, just a couple of years later, and all of a sudden you have banks with a liability side of the balance sheet paying much higher average interest rates than the asset side. So, for example, what did in SVB was a combination of all of these assets at 2 or 3%. Again, doesn't matter if it's mortgages, T-bonds, whatever the case may be. But on the liability side, they had deposits paying 5%. Well, that obviously is negative cash flow, and it's a quick path to insolvency. And the issue for so many of these banks is that if they actually have to start selling off these assets because they're selling them at a loss, they need to basically keep selling them and liquidate everything. I mean, it's not an exaggeration. That's why some of these banks failed so catastrophically. And the problem is it hasn't gone away. That structural issue is still there. And so, going back to that tweet you were talking about, I have to wonder more and more, is this Fed rate cut, does it have anything to do with inflation or the labor market? Those numbers don't really seem to add up. None of those excuses make a lot of sense. And a lot of people have said, well, then it must be political. It must be election interference, essentially. Maybe it's also because the Fed is secretly trying to bail out so many of these banks that, again, have $500 billion of unrealized losses on their books.
That's amazing. It's funny. As we're having the conversation, I find myself going back to the assets equals liabilities plus stockholders' equity equation, which was, for those that traded through it, which I did, and you were in your seat at the same time. We've lived through these things, and that equation stuck with everyone for 2 years through the credit crisis. I never saw so many traders sitting on the desk trying to talk about assets, liabilities, and stockholder equity versus, where did the 500,000 go up and how many can I buy there? It really changed our conversation. And that's kind of the feel I'm getting from your explanation of this, which kind of sends some chills down my spine, having been through the 07, 08, and 09 market. Let me ask you, as far as the assets that they're holding, are they generally held at larger banks, or are they generally held at regional banks, or is there a mixture?
So I guess probably the best way to say it, Anthony, is that it is a mix. If you want to just look at it in absolute terms, then yes, it's large banks that hold most of these devalued assets. But if you want to talk about it in relative terms, in other words, as a percentage of balance sheets,
Hmm.
then it's not large banks anymore. Now it's disproportionately small banks. And again, the small banks are the ones who got on the wrong side of the interest rate trade big time to begin with, and they've just never been able to crawl out from under that. And you may think, well, but rates are higher today. So what is stopping these financial institutions from just getting more assets on their books at today's higher rates? The problem is that people aren't, the loan volumes essentially have just plummeted. So people aren't demanding credit the way they used to when rates were, somewhere between 0 and 2% on a lot of these different types of debts. I mean, that makes total sense, right? Okay. But it still puts the banks in this terrible position of they're having difficulty turning over that balance sheet, again, from the very low average interest rate to a higher interest rate to try to match their liabilities.
Amazing. Okay. And there's also the point of the bank's credit requirements have gone up substantially because of the risk of default, because of the fact that people are struggling so much, because of the top-down policy, because of the inflation and the environment we're in, which is, full circle. Um, did you raise 50 basis points and then start talking about another 50 at the next meeting because we're doing so well? I don't know. I think I'm skeptical. I think the markets are kind of consolidating where we ended up the day after the announcement, but I'm skeptical. I'm finding it hard to believe that we are cutting rates the way we're cutting rates and talking the way we're talking because things are so good. That just doesn't make perfect sense to me, especially when we look at the unemployment numbers, which we've talked about, that are on the rise and typically will rise, linearly up versus kind of choppy. They're going to move as they start to move. They will move. This is fantastic, EJ. Thank you very much for going through this and actually explaining it. It's something most people are not looking at, and it's like everything else, right? It's not a problem until it is, and then we'll be back in the same situation we've been in the past and wonder why. Along the lines of, I grabbed this morning, things not being so great, but us saying that they're great. China overnight, big announcement. The central bank unveiled a broad package of monetary stimulus to revive the world's second largest economy. So they're trying to overcome slowing growth and depressed investor confidence in China. It doesn't seem like we're really in a raging bull market, although that's what the headlines read, although we know the headlines could be somewhat deceiving. Right now, they're lowering borrowing costs by as much as $5.3 trillion in mortgages and easing the rules for second home purchases. They're also, the central bank in China is also going to provide at least $113 billion of liquidity support, adding that officials are setting up a market stabilization fund. So they're really in the same boat as everyone else. They're trying to artificially prop up and hold and add liquidity to the markets to kind of kick the can down the road and stop
Mm-hmm.
a caving in of capital markets and real markets. So we have China actually adding liquidity to prop up the real estate market, real assets, and capital markets. At the same time, we have the Fed now cutting rates, saying that inflation is somewhat maybe under control, but there's obviously weakness in the jobs market and potential weakness in the economy. So again, dueling forces here, which are they're not going to lead us to a soft landing or a resolution, in my opinion. I guess my question is, as China makes a move like this, how does this affect the effectiveness of or the results of the Fed's move recently in the U.S.? How does it affect our fiscal and monetary policy here? It seems like we are just a sandstorm of misdirection here, and we're heading towards the same spot, which is a hard landing.
Yeah, Anthony, I don't know how you get out of this without a hard landing. We keep hearing about this soft landing, and this has happened the last several times right before we went into a recession, into that hard landing. The Fed has never pulled off a soft landing in its 100+ year history. I mean, literally since 1913, they've never actually managed that soft landing. I don't see any reason to expect that that this time will be, any different. Now, to your point on China kicking the can down the road, yeah, I think that's exactly what they're doing. And the crazy thing is that it's really hard to get a sense of what exactly the Chinese government is doing and just how much stimulus they are injecting into their economy. We can look at, for example, countries like India. We can look at the Eurozone. We can look at even places like Russia and take the purchasing manager indexes that are published for each of those countries by different international agencies, and we can actually get honest data. Again, even from places like Russia, you can't do that with China. You just can't trust any of those numbers that are being reported. I mean, for how many years there did China grow at like exactly 7% year after year after year? Because, well, that's what the Communist Party told us we were going to do, and voila, we did it because communism works. So again, you just can't trust the numbers. We literally have to verify international transaction, or we have to use international transaction data from China's trading partners in order to try to verify things like purchasing manager indexes coming out of China and other data that's published by the Chinese Communist Party. So all that to say, it's difficult to say precisely how much stimulus is being injected. But as you know, they've been doing this for a while now. It sounds like they're really stepping up. It sounds like they're going to try to impose some price floors on different equity markets in order to try to, just keep the stock market propped up, essentially, which means a lot of government spending, a lot of money printing. And unfortunately, it seems like we are making similar mistakes, maybe not to the same extent, but we are making similar mistakes here where inflation still is not dead, but the Fed at this point is all but declared victory, is taking their foot off the brake. And I think it's only a matter of time before they put it back on the gas, unfortunately. This, in my opinion, this is all pointing to more inflation down the road. But you couple that with the fact that we really aren't slowing down the government spending. We're really not slowing down the transfer payments, which is important to consider when we look at the consumer spending numbers. For example, even in the GDP report, we consider that to be private sector spending. A lot of it's really not anymore. Government transfers, in other words, I'm going to take $1 from you, I'm going to give it to myself, and then I go out and spend that money. That doesn't get counted as government spending, even though government facilitated the transfer. It gets counted as consumer spending. The problem is that it still kills your incentive to work just as much as if the government taxed you that money and spent it directly. Like, let's say they go out and buy concrete or asphalt and go pave a road. So it doesn't really matter how the government spends the money or who at the end of the day spends it. The fact is they took it from you to begin with, which gives you a disincentive to work, which means less work, which means slower economic growth, which means smaller economy, all else being equal. So I say all of that to say that not only are we looking at an increasingly inflationary environment going forward, but an increasingly stagnant economic situation going forward as well. In other words, that dreaded stagflation. So, throwing it back to you, Anthony, I would love to know what are the types of, I guess, portfolio allocations you might want to consider in such an environment. What are some things you can do to protect yourself as an investor? I mean, it's one thing if you have an inflationary environment, but it's coupled with pretty rapid economic growth. I think it's a totally different beast, though, when you are seeing asset prices rise without an increase in real value attached to it.
Yeah, great question and great summary, by the way, on the China issue. I'm always in awe of the explanations and the way you put it. Before we get to the asset allocation and the markets, and I love the disincentive to work because it's a real thing. People are not dumb, although I think the current administration believes they are, and maybe a portion of them are. But we had consumer sentiment out today, which was pretty important. We're going to run a tape of CNBC's rundown on the numbers, but the number came in at 98.7 versus an estimate of 104. So we're dipping back below par, back below 100. Let's go to that cut, and then we'll go through consumer sentiment and then kind of where we see the markets and where we're allocating.
Economic data crossing the tape. Rick Santelli has it for us. Rick.
Yeah, we are looking at some big misses here on consumer confidence. We're expecting a headline number to be around 104, 98.7. 98.7. That is the weakest going back to February of 21, July of 22, when it was 95.3. So these are definitely weaker than expected numbers. Now, let's go towards present situation. 124.3, also a very big miss. That's the weakest since March of 21. And here's something very fascinating. This now, if you look at the July read, that was the weakest since April of 21. So we are really looking at present situation deterioration. And if we look at what lies ahead in the form of expectations, minus 81.7, and that's the weakest, well, just since July of this year. Now, let's switch gears towards Richmond Fed. We have both manufacturing and service indices. On the manufacturing, minus 21, which means it's 11 consecutive negative number in a row. And here's something fascinating. If we look at the business side of it, the service sector, it's minus 3. Our last look at minus 13, well, it was the 30th negative number in a row. So minus 3 is definitely a big improvement, but it's still 31 negatives in a row on service sector with respect to Richmond Fed. So we are looking at yields moving a bit lower on the long end. And do keep in mind, the long end is on pace for its fourth consecutive higher yield close in a row. Every close since last Wednesday's 50 basis point cut by the Federal Reserve.
So what's interesting is, and this is exactly what we've been talking about, consumer confidence, consumer sentiment down and continuing to drive down. I mean, these numbers were back in mid-21, we were at 130 on the survey, the Conference Board Consumer Confidence Survey. We're now dipping below 100, and the COVID lows were down around 88, 85. So confidence is down, services sector growth down, manufacturing, industrial growth down, and the Fed is telling us that they're cutting 50 basis points because everything's really good. They just want to make sure they're ahead of the curve. I honestly, there's an old expression, I don't know if anyone's heard it, but it's kind of like, don't piss on my leg and tell me it's raining. And that's kind of what goes on here. And that's why people like Grant was out last week saying there is a crisis of awareness at the Fed. They're not aware, and they actually think that they're going to shift the narrative and move this entire market. And at the end of the day, and we all know it, and so does the Fed at the end of the day, the market is bigger than anything the Fed can produce or put in. They may be able to kind of massage it, move it, and kind of misdirect it a little bit. But at the end of the day, when the market does its thing, it will do its thing regardless of what the Fed's doing. I just think that they're continuing to make it worse. As far as allocations, it's a tough spot. It's a tough spot. So I'm not typically in a ton of precious metals, but I think gold is, even at these levels, is a good place to be invested. We're currently front month at, up 70 bips today at 26.47. There is zero reason, and I've said this in the past on the show and otherwise, there's zero reason we should not think gold will be at 3,000, especially as we see the DXY, the US dollar index, down at par and about to break below par. We have a dollar that's weakening. It's been weakening for the past 12 months. We have gold that's on the rise. We have miners now in basic material companies actually starting to catch up. The miners have been on a tear lately, finally catching up to the commodity. That's been a fantastic trade. So I think precious metal is a place to be. I think the yield on the 10-year is still a place to be if you can get some risk-free return there. I think that's a solid investment. And then I think you need to be careful with how you're invested. Now, most of my model calls tend to be intermediate term calls. My calls on the momentum trend model could be anywhere from, a week to 2 weeks to 6 months. So with that, I have hedges built into the way I do things because I'm not a swing trader. I'm not a day trader. Some trades may turn into swing trades, meaning a few days to a few weeks, but typically I am very responsive to the market and the way the market's moving. The model has been predictive. The model has been successful, and so has the trading. So I stick with it. This is the way I do things. If you're a longer term buy and hold investor, you need to be taking some investments off the table here. I truly believe that. Any money manager telling a client otherwise is not depending on where they have those assets allocated, is maybe not doing, in my opinion, the best job that they could for their clients. I'll get away from the investment advisor private banking conversation and just stick with me. Precious metals, gold and silver is definitely a place to be. There is a place for bonds in the portfolio just based on the current yield. And then you need to be involved in the equity market, but you really, there's a flashing yellow now for sure, and you need to be aware of that, whether you hedge out or you start to de-risk. Now, I will tell you that my view has always been, as a portfolio manager and as a trader, the best hedge is to de-risk, meaning if you have 100 million in long exposure and you want to try and hedge that by 50%, most of the times it makes sense, especially for an average investor, to just de-risk by the 50 million, meaning take that off and go to cash. And that's exactly the point I'm trying to make. Don't get too cute. Don't step out of the market completely. There's no reason to do that. And over time, like everyone knows, the market will continue to go higher and you'll make money. But for now, I do see us in a pretty tough environment. I see us in a very choppy environment. I see, sovereign banks getting involved, the Fed getting involved. We have an election coming up. There's a lot of reasons to think that the volatility is going to kick up and will remain high. In addition to the fact that there is very little discounting done to geopolitical risk these days. The war in Ukraine and Russia kind of came and went. We had some movement in the chem names. We had some movement in certain natural resource names. Kind of came and went. The war in Israel the attack on Israel has been shocking to me because we just haven't seen a lot of market reaction to that. I think it's kind of like a numb response by the market. So there's a risk there as well, which I don't believe is fully discounted at this point. All said, I remain to hold some precious metals. I remain net long on balance here. But to be honest, even though, and I write it in the report every day, where my signal is and kind of where I'm positioned and what I'm thinking, the signal is positive. It's been positive for its third day coming out of that Fed announcement. We shifted from a neutral to a positive. But I am pared down. I'm net long, but I have a lot of cash on the side right now because I'm not willing to take a bet in the current range. And that range for me, and you can read the report for EJ, anyone looking for it, you can go to islandcapitalinvestments.com. You can sign up. The report's delivered daily, or you can go out on exit at CMT_Anthony. That range for me here is 57.33 at the top on the S&P cash index and 56.86 as support. It's a tight near-term range. That's the trading range. Through 57.33, I'm a buyer, and I'll add to my position. Below 56.86, I expect my momentum trend model to shift down to neutral or negative. In that case, I would be in cash or leaning short. So it's a tough market. We're actually having a great September. We've gotten through this volatility, and I'm satisfied with where we are. I'm ready, honestly, to close September and move to October. But we're going to see a lot of volatility, so everyone needs to be pretty careful and pretty on top of what they're holding, and don't be afraid to hold cash. Cash brings you zero loss, maybe with inflation, but let's put that to the side. You have cash, you hold your cash, and it brings you all the optionality you want. So cash is not an evil word. Cash at some points could be king, and I would recommend having some cash on hand more than you would in a normal market at this point.
Hey, Anthony, I'd love to know, how much do you think of the mistakes that investors are making today are just kind of psychological and people getting gun shy, or at least they're trying not to repeat the same mistakes they did before? A couple examples was so many folks that I knew, and I realize this is anecdotal, but so many folks that I knew in 2020 got out of the market either at or near the lows because they were just scared. They were the typical investor where they were selling low and then end up buying high. And then a lot of people who essentially got into cash and just got absolutely crushed then by the inflation losses, where, they've literally lost almost a fifth of their cash balances that they kept in cash for several years, right? So they made obviously a couple of mistakes there, but how much of when I talk to folks now and all of a sudden they've turned into like permabulls, and they think that this is nowhere to go but up and always will. I mean, how much do you think that the violent moves we've seen the last couple of years, whether it's equity valuations or whether it's general level of prices, how much is that weighing on investor psychology, do you think, today, and is prompting people who don't have this kind of rules-based strategy to make mistakes?
Yeah, it's actually, the rules-based strategy for me has been something that I've grown up in the business with. I was on the floor of the New York Stock Exchange for 17 years as a sales trader and a broker, and started to pick up on technicals at that point to add to the ability to trade for clients. I was at a very large family office for almost over 7 years, where everything we did was rules-based. We built the models, we back-tested the models, we presented the models to our principal. We were able to tell them on a look-back period for anywhere from 50 to 100 years how this thing performed and what we should expect. So rules-based for me is kind of where I sit, not forgetting that I have some gray matter in between my ears, and I say kind of a little bit, not too much, but enough to be dangerous. It's important. I think the behavioral finance side of this and the way people are destined to repeat the same mistakes is significant and is real. So with that, you'll see permabulls here and everything's great until it's not. And you'll see the recognition phase of the bear at some point we will have, and then the fear phase, and then the capitulation. And on capitulation, all we see, deep spikes down, heavy volume. That means people are selling at the lows. And then it takes you a little while to come back in. So not only did you sell at the low, but now you're chasing back up, whether it be 5, 10, 15, 20% higher. And now you're legging in. So now you're working that stop. Before you know it, you were at this spot where you lost, a third of your money because of timing, which is very possible, if not more. The other thing I'll say that's really interesting, and I talk about this all the time, although I'm not an old goat, I'm kind of an old goat. I've been around for a while, traded through the late 90s and into the tech bubble, traded through the housing crisis, traded through, COVID, traded through 2016. I've been through it. A lot of the traders out there and a lot of investors out there, this Robinhood crowd say, they haven't seen a market that hasn't consistently gone up. They haven't seen a market where it wasn't buy the dips worked. They've never seen this. Most recently, we saw the dip down into, mid-July to late August to kind of early August. That was an event for them. For me, that was a blip. That was the beginning shot of we are starting to top. We are starting to work through the process, potentially. For them, that was a bear market. That's not a bear market. Bear market's when you're down 50, 60% and you don't know if you should buy more stock or canned foods and bullets because you don't know what's going on, right? Like, are the capital markets even going to survive? Forget about my E-Trade account. So I think behaviorally, we're much more afraid of missing out. There's that FOMO in the market. I think it's a real thing. And I think that as we move through this cycle, the same people will make the same mistakes. The talking heads will talk them up all the way at the top, and then we'll be about halfway down. They'll start to get a little teary-eyed, on weekday mornings on the show, and then down at the bottom, they'll kind of have nothing to say. It's going to be the same movie over and over again. And believe me, I fight with myself and my own psychology and emotion to make sure that I'm positioned the way the market is telling me to be positioned, not the way I think the market should tell me to be positioned. And that's really a key too. You can't want the market or will the market to do what you want. You have to really look at what's going on, be objective, whatever your process is, and be able to make that call, whether you be long, short, flat, cash. You need to be able to be objective with what's going on. And there is never anything wrong with taking some profits, putting some cash to the side and taking a step back, especially at a point where it looks like it might be a little toppy or you're not feeling it, or your model is showing you something could be going wrong here.
The power of a rules-based strategy, ladies and gentlemen.
A good one. You only have to be right 51% of the time.
There you go.
Ish. EJ, thank you very much. It's been a pleasure. You actually absolutely fantastic today, as usual. Those assets, something we're going to keep an eye on. We're going to circle back to that and see what develops there. Thank you, sir. Have a great day.
Anthony, the pleasure is mine as always. You have a good one too, my man. Until next time.